What should I do with my money? How should I invest it? This is one of the most common questions that I get asked in my practice. And while we aren't financial advisors, we're not going to tell you to buy this stock versus that stock. It is a really important question and one of the ones that we advise a lot of our clients on. We've broken this up into 5 main categories, each one with varying degrees of risk and varying degrees of reward. We'll start with the ones that are the most fun first. And just to be clear, these are all things that I have done personally. We would not be advising you on things that we had not experienced ourselves. These are all things that I have made and occasionally lost money doing myself. Number 1, reinvest in your own business. Medium risk, high reward. So this one should be a no-brainer, but you'd be shocked how often people don't want to reinvest in their own business. They just want to squeeze out every dime possible from it and have the maximum profit. And sometimes they do this because they want to spend the money on themselves, spending on something personal. Sometimes they just want to sit on it and hoard their money like a dragon in a cave or something. And sometimes, and this is the one that's the most puzzling to me, they want to take that money out of that company and that investment they control and give it to somebody else and invest in something that they have no control over.
I figured out something better. A metal detector.
What?
Yeah, it combines 2 of America's greatest resources, garbage and luck.
That's stupid, Peter.
Look, running your business obviously has risks. There's obviously going to be things that you lose money on, obviously things you don't get a return on. But if you're running your business successfully, especially successfully enough not just to survive, but to have surpluses of money to invest, the rate of return you're going to get on reinvesting in your business will be leaps and bounds above anything else you could possibly get with an outside investment. It could be that you just increase your marketing budget. You could have more staff that you hire on. You could hire some professional consultants to help you run the business better. The list of things is endless. But your business is something that you control and that you're intimately familiar with. So even though small business on the whole has risks, the risk in investing in your own business is relatively minimal. Number 2, partnerships and investing in a colleague's company. This is going to be high risk, high reward. So now we're getting into a little riskier territory, a partnership or some kind of a joint venture. These can take all kinds of different forms, but a lot of times it seems to happen with a colleague or one of your clients. The makeup of every deal is different, they can be structured a lot of different ways, but usually these deals seem to have some commonalities to them. They're usually going to be new ventures, not existing companies. It's usually going to be a side project for all parties involved, the person you're partnering with and yourself obviously because you have a main company. And a lot of times it seems to be in an industry where neither party, especially you as the investor, are super familiar with. These can go really well or they can be catastrophic failures. In a best case scenario, you have a large ownership percentage in a successful company, and ideally a company that provides some kind of peripheral benefit to your main business. And all of this with minimal effort on your part. So that's great. But just as often, if not more often, they fail. You have all of the risks of starting up a new business, and then you add the complications of having a partner, not being in full control of the investment, usually not being as familiar with the industry, among other challenges. So very high risk, but very high potential rewards. Number 3, real estate. Medium risk, medium reward. Next on the list is real estate, and it's in the middle both in terms of risk and potential reward. Now I love real estate. There's a lot of flexibility in the way that you can structure the investments. If you want to be an owner-occupant, you have the ability to pay towards something you own instead of just paying rent. And it's just kind of fun because it's a tangible investment and something you can look at, not something that's more theoretical, as is the case with a lot of investments. But most importantly, at least in most cases, it's a highly leveraged investment, meaning that it uses debt. Now, most people want to avoid debt. They think of it as a negative thing, but it can be a really useful tool when it's used properly. Let's say you buy a building for $1 million, which would in most cases require a $200,000 deposit. That real estate appreciates 2% a year, so it goes up $20,000 in value. Well, $20,000 on $1 million doesn't sound like much at all, but you as the investor did not put down $1 million. You put in $200,000 of your own cash, so you're getting a 10% rate of return on the money you actually invested. And that's just on the appreciation of the real estate's value. That's assuming that you have no profit, which hopefully the building would be generating for you, which would further amplify the effect of this leverage and the use of debt increasing your return on your investment. One of the least used metrics in investing is return on capital invested, or as I like to call it, return on my money.
It's my money and I need it now.
The use of debt through real estate provides a really unique opportunity to utilize that power. That being said, debt obviously has its own risks. And buying a single building or a group of buildings is not a diversified investment. You have the good and the bad that comes from owning that one building. It could be that a tenant stops paying their rent, that there's a vacancy for a long period of time. You have more repairs and maintenance than you expected. You've got deferred maintenance on the building. There's a lot of good and bad that comes from owning that one piece of property. So again, medium risk, medium reward. Number 4, the stock market and retirement accounts, low risk, low reward. All right, so now we're getting into the less fun parts of the list, but more importantly, they're the ones with the least risk exposure by far. And this is especially true if you do what we recommend and you're investing in funds, index funds and mutual funds, and not just trying to pick whatever today's hot stock is going to be. The stock market goes up somewhere around 9% a year. There are going to be years where it goes up 30%, years it goes down 30%, but in the long term, that's the average that you can expect to achieve. So if we're looking at this in terms of long-term investing, your risk exposure is relatively minimal. Now, of course, you don't want to put the money in there that you're going to need in the short to intermediate term. You don't want to put the money in there that you're going to need to fund payroll next month, because if you do have a 30% dip and you have a big drop, then that can be pretty catastrophic for your business. So again, we're looking at this with a long-term view. And that rate of return is amplified even further if you're doing that in retirement accounts where you get the tax advantages that come with that, be it with a pre-tax account where we get the write-off now, or a post-tax account where the distributions aren't taxable in the future. But either way, be it in a brokerage account or a retirement account, your risk exposure is pretty minimal if you spread it out over time. Number 5, parking the money in savings. No risk, next to no reward. All right, so the last item on our list is easily the most boring, but it's the one that comes with zero risk. And again, you would think putting your money in a savings account or buying a CD would be a no-brainer, but I'm always shocked with how many entrepreneurs I deal with who have tens of thousands, if not hundreds of thousands of dollars just sitting and checking, earning nothing at all. If you have $100,000 parked in a money market account, that's a free $2,000 at the end of the year. Granted, $2,000 on $100,000 isn't setting the world on fire, but it also takes zero effort on your part and there's no risk associated with it. So if you've got some degree of cash excess, but you think you're going to need to use it in the future, you're going to have unexpected expenses that come up, you do what we recommend and you're reinvesting more in your own business. Instead of just parking and checking, you can at least put it in a savings mechanism of some kind and get some small degree of return instead of nothing at all. Really, there's no right or wrong answer. The choice you make is going to be determined by your risk tolerance and also how much effort you want to put into it, how actively involved you want to be in your investments. But whatever you do, just make sure you're doing it intelligently and making an informed decision, not letting fear of losing the money potentially or unbridled optimism make the decision for you.